Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to accomplished UK fund manager Richard Staveley of Rockwood Strategic. So, big welcome, Richard.
Thank you very much, Paul. Great to be back and looking forward to a fun discussion on some of our holdings.
Yeah, well, you're not looking as forward as much as I am, I'll tell you, because the returns have been terrific. In fact, actually, the Rockwood shares have more than doubled over the past 3 years compared to the AIM index, which is as total flat as a pancake, big 0% return there. So maybe we can start on those particular performance. Can you just quickly walk the audience through or remind the audience what that magic wand is behind Rockwood?
Well, that's very kind. There's definitely no sorcery involved. I think. Look, we are definitely differentiated than the most small cap funds, and we're differentiated in a number of ways. I think the first is that we only buy stocks at the point of entry that are below 250 million market cap. That's relevant because most of the even small UK small cap funds, either because they've got too much AUM or because they've got the liquidity constraints of running open-ended funds as well as investment trusts, tend to be either steer away, or they're told they're not allowed to, or basically avoid the more illiquid part of the market. That creates a super inefficient part of the market. So we're hunting in I would say, let's face it, slightly easier ground than maybe they all are higher up the market cap. I think the second thing is we then lean into that and take a concentrated approach. So, most small cap funds have a much more diversified portfolio. And then as a result, they're going to give you a result much closer to what the market's done. And as you've just explained, the market's been awful. So our top 10 holdings represent the majority of the capital in the fund, and we have just over 20 holdings altogether. And that concentration means that our winners win. It also means that our losers can affect us too. But overall, we've been getting our stock picking right, so that's been great. I think the third thing is we're kind of unashamedly kind of value investors. So that's what we're focused on. And for us, that means kind of assets, free cash flow generation, potential for free cash flow generation, and the sort of special sits aspect of unlocking value in businesses. And quite a lot, I would say the majority of UK small company funds, and indeed maybe even private investors, tend to kind of like sort of magnetize towards more growthy stocks, which we genuinely tend to see have a bit more risk in them. So we steer clear of biotech and mining shares and unproven technology and that sort of thing. I think the other piece is that we're active. So a lot of fund managers either outsource it to their corporate governance departments, who are more about box ticking and voting and things like that. We actually, so of our holdings, 15 of them, we now have over 5% of the equity in, which means, as you know, we could call an EGM if required. Now, we're not into doing that every single time, only really where the discussions break down when common sense is obvious and the board and management are sort of saying, go away, Richard, we're not interested. And we think the rest of the shareholders actually think what we're suggesting might make a lot of sense. But mostly sort of sense prevails, people are constructive, but you need to have that kind of a stake. In conjunction with that, we've got 10 of our stocks we actually have either proposed a board member to on behalf of all shareholders, so they're not a Harwood kind of representative or anything, but they're someone that we think is going to really make a difference. Or we ourselves and people actually linked to Harwood are on the board of 10 of our holdings. So it's that combination of real active investing, active engagement. And I think it just to round it up, it's probably only fair to say that we are totally focused. So this is the only fund I do. I mean, I know you have quite a few people on here. A number of them do other things as well as will have a number of funds or management roles or things like that. I'm just totally focused on Rockwood. Mrs. Staveley and I have just over 1% of the NAV, and Christopher Mills, who founded and owns Harwood Capital, he personally has bought 19% of the NAV now. It's been diluted because of our growth. And I think actually our very first meeting, Paul, you'll probably have to check the annals for this. I'll probably get this wrong, but I think our market cap when we first met was probably about 40 million or something like that, 45 million. I am absolutely delighted to say that, you know, in the last 3 years, as a result of the performance and raising money into this trust, so that's net flows into UK small cap, not you know, the opposite of what everyone's whining about. We're up 267% total, and the NAV is now 135 million pounds. So, you know, I think that's just really something to hopefully we can all celebrate and continue to grow and to perform.
Yeah, well, I mean, 100% alpha generation over 3 years is a pretty good record to try and emulate, actually, going forward.
Well, it's definitely not something I'm going to promise again. I can tell you that. So just to remind investors or people that are looking at this who don't know Rockwood, is our target return. We don't target a benchmark. We think they're dangerous things to think too much about. We basically have to have a thesis of when we buy a share that it'll have at least 100% upside, often has a bit more, on conservative expectations for a valuation re-rating or growth alongside growth in the profits. And we take a view that over 3 to 5 years, that re-rating will occur and those profits will move back to, or returns will move back to those returns. If that happens and the stock doubles over 5 years, you know, we'll deliver our kind of target of 15% IRRs. Bit of costs in the fund, so that would be the gross return. So our kind of ambitious target is to sort of double the fund every sort of 5.5 years. That would be our kind of ambitious target. If we keep doing that, we'll remain number one. We are number one, obviously, but it's no point having sort of, you know, you got to push yourself, haven't you?
Yeah, no, I mean, we've done terrifically. Okay, well, let's move into some questions, because I had an absolute ton of them being pre-submitted. We've got Stuart. He's asking about probably your best one, which is, or the moment currently one, Filtronic, which does specialist communications equipment that go into various products. But they've inked a fantastic partnership with SpaceX. That's Elon Musk's low Earth orbit. And the shares really have gone to the moon since that. So do you want to take us through your latest views on that particular share and whether you're going to sort of top slice profit or just keep running it?
Yeah, so just to add, so this is actually, again, really good for the UK stock market. It's clearly now a global technology leader in what is an emergent new market. And that's the key. Although the shares have done extremely well, I think we've made 10 times our money or something like that in it, which, you know, that's just a great feeling, of course. The business, the actual market that they're exposed to is only just getting going. So SpaceX, that you mentioned, their largest customer, and a huge amount of customer risk. So it's about 83% of sales is SpaceX now. But they're giving them contracts which will drop into next year and the following, and seem to be kind of almost a kind of permanent part of SpaceX supply chain for their Starlink network. That, you know, that they have only still got 8,000. They've got 8,000 satellites up now in low Earth orbit, and they've stated targets that they want 42,000. So they're putting up a lot more. Kuiper, which is Jeff Bezos's equivalent OneWeb, which he's been having less success with his rocket, has only got 27 satellites up, and he's targeting 3,000. Just to give a sense, and he's probably second in the game. Now, there are other ones like OneWeb, and guess what? This year, Filtronic have announced they've won via Airbus product into the OneWeb network. Viasat is another provider for satellite networks, and they've actually got into the satellites there at Viasat. Now, why this is important is because all the contracts they've won with SpaceX so far have been for the ground stations, for what's called the E-band, which is the wavelength that Elon's gone for in the first instance. And without going into a sort of physics lesson, because it'll show up how little I know about this sort of thing, as the data gets more rich and there's more volume of traffic and more people using the network, they need to start to optimize other wavelengths. And those need to be solved for technologically. And it's not just, you just don't switch them on. And Filtronic are essentially solving that problem for SpaceX, who can't solve it or haven't been able to solve it themselves. So they're looking, the other wavelengths that we think are being looked at are W and D, although there's nothing been announced about that, but also the V band. And the V band, Filtronic only launched their Prometheus product in June for that band. Now the point being here is that when if Starling were to adopt other bands and adopt Filtronic's technology, they'll have to redo all the sales by updating all the ground stations. At the same time, the fact that they're winning into the satellites themselves with people like Viasat means that one shouldn't write off the fact that they actually end up getting into Elon's satellite network as well. Remembering, amazingly enough, that apparently the lifespan is about 4 to 5 years of each LEO satellite. So he's going to have to do the whole thing again. It's not like the GPS ones that were up there forever.
Is that because they get sucked into the orbit? Or they basically burn up because they're low orbit. They get burned.
Yeah, I think and also the technology just kind of like the speed of which it means that they become redundant actually. So they just need to replace them. Everyone goes, by the way, there's an obvious, isn't there going to be too much stuff up there? Isn't it going to, too many satellites? So to remind everyone, there's a reason why it's called space. So if there is a huge amount of space up there, so we shouldn't worry about that aspect that some people sort of scaremonger under. I would say though that the speed of the LEO constellation rollouts could hit an inflection point over the next couple of years in terms of acceleration elsewhere. And the reason why this is what's kicked all this off is Elon Musk's amazing rocket technology, which I'm sure almost everyone would have watched either on the news or wherever. Just to put it in context, the shuttle, which we all remember, the space shuttle, that cost, at that point, bearing in mind there's been a bit of inflation since then, but it was 16 million quid a ton, right, of stuff into space. The Falcon 9, his first re-entry rocket that was been successful, is $4.8 million a ton, and the Falcon Heavy, which is what sort of happening now, is $2.4 million a ton. And the big one, the one he's calling the Starship, which is really the kind of end up getting to Mars, that's behind it, but in the first instance we'll be able to go up and do payloads to the moon and out of it. That's they reckon they can get the cost down to $1 million a ton. The point that is that at the moment there's I can't remember off the top of my head, but there's a set number of satellites that can go into this current Falcons, but you can all of a sudden you can put loads more in, and that will allow people to just buy one rocket launch, and all of a sudden they've got many more satellites up. I think to answer your question, though, I'm not avoiding it. We've sold over half our shares now. We've prudently taken profits all the way, but I would suggest this is how it's an important aspect for private investors versus how fund managers think. Despite that meaning, they're getting out. This is the end. It's still in my top 10 holdings. So it will hurt me a lot if it collapses in shares from here. It's just we're managing the size of that position within our top holdings. It's roughly about 5% of Rockwood now. We would expect there to be upgrades to this year's year to May. We think that the 2027 numbers look easily beatable with contract awards that they could easily announce over the next 6 to 9 months. And the key for people have to remember is that there's a high drop through rate of profitability at Filter. It's very profitable, and they're moving in the next kind of 2 months to their larger facility, which is 2.5 times bigger than the existing one. And you don't do that without having a good steer from your largest client about how much business they're gonna give you. So they have good yields. It's highly efficient. We think they should mature at about a 30% margin, EBITDA margin. And you could, sort of the current blue sky thinking, which feels less blue sky than it is that it's not quite clear which year this will land, but we're looking at potentially a business that could be doing 150 million of sales, making 50 million of EBITDA. It's currently making 12. Yeah. So the high valuation, just over 4 times, but not a particularly. If it was in America, you could go completely nuts, couldn't you, with the valuation? But they're on a kind of 30 times, very late 20s. hard for us to justify a brand new position as a value manager, but we're running our winner here and just carefully into good news, just come gradually moving on. We'll probably look back and go, why on earth did we sell all of it down here? But we're locking in a lot of profits. So.
Yeah, and let's be clear about it, you can redeploy in other areas. One thing actually that I did hear over the weekend in terms of space exploration is that the next thing they're trying to put into orbit are data centers, because it solves the energy problem. You just have permanent solar, have your solar panels out there so it can power your data centers. And because it's sub-zero, well, basically it's absolute zero, minus 372 degrees, then you don't have a cooling problem either. So that's the latest thing they're thinking of, and it'll need plenty of communication. But
I go back to, I think I would conclude we spent a lot of time in the stock, but it's worth you talking about, because I know lots of people are following this, and it is a really exciting story. Is just go back to the point. I know everyone, it's very difficult not to become quite myopic and think about investment returns in short-term time horizons or trends or how companies have behaved. But this really, what's happening in space now as a result of what Musk has achieved is really, it is completely changing the economics of space, what you could do with space. And that's, they're a really interesting position in the supply chain to support all the data movement and communications that will come with that.
Yeah, no, good point. Okay, let's move on. We've got Graham, and I don't know how much you can talk about this stock because it's Treatt basically, which is a flavors and fragrances business, and I know it's currently under offer by Natara, which is a trade buyer of flavors and fragrances, and there's also another shareholder with 10%, Dola, who's also a trade operator of flavors and fragrances. And I know the question I guess comes down to if you can say anything at all about how, you mentioned about it 2 weeks ago, I think, in your trading update for Rockwood, and then you've now moved to irrevocable agreement with the actual. I don't know whether you can say anything, but if you can, then I know Graham would appreciate it.
Yeah, I can say a few things. It's quite frustrating for us because we did quite a lot of work to establish that the shares were definitely undervalued, and we established a position. And we don't buy many shares in Rockwood. We buy maybe 4 a year or something like that. So we're making lots of decisions about what to go for, what to not. And we'd started building a position quietly without people working out we were doing that. And we got up to 2.95, so we didn't have to trigger an announcement that we'd got it. And we hadn't fully completed all the work we wanted to do. They were being quite difficult about access. Turns out why in the end. So we weren't quite sure, and some of our due diligence was making us realise that there was going to have to be some likely change, meaning we'd probably end up needing like 5% of the company to make sure change was happening, either with management or board, or even some strategic decision making around that. So and then subsequently the bids come in at a kind of a low level to what our kind of 3 to 5 year conservative expectation of what we could do, thinking we were going to make double our money. So obviously, quite a lot of people have held it for much longer. The first thing I would say, I don't know what you're bringing up the graph, aren't you? I think one thing I would say was what we've come out as is we think quite a lot of people were maybe even had the wool pulled over their eyes, or were definitely believing that this business was actually lots better than it was, and they're also much happier owning it on what we would have called an overvalued multiple for some time during the period of zero interest rates, and maybe got comfortable that Treatt was just a bond, like grow a bit every year, super duper stock that should be given a high multiple. And there's no doubt that ingredients is overall as a growth area, and they should probably have a premium to the market. But I suspect some of the share price highs were, frankly, people should have been selling, frankly. So we get to where we are now, and you're able to buy the stock, which we did, below net asset value, which is a real net asset value with a brand new shiny factory and loads of stock and an unleveraged balance sheet, and that's why we got involved. Now the bids come in. We were first contacted. I think I can say this now, but like the original pre-announcement where we were brought on side, I think they were as low as 256 or something they were talking about on the Friday, and we said, don't be ridiculous, and they bumped it a few p to 260p. I mean, it's like, really. And then you obviously, as you mentioned, Dola have built this stake. Now, Dola haven't reached out to us. They're from Germany. They're another trade buyer. We speculate that they might be interested in owning just part of the business rather than all of it. They might. They will be well advised or advised in a certain way by their advisors about how to play this. But they're over in the UK having to deal with UK shareholders, so their plans might not work. There are different types of ways you can take. It's a scheme at the moment, 75%. They could move to an offer at 50%. Are irrevocable that they would then put out. So then the new exponents come back with 290. We felt that was sufficient for us to say we'd be happy to lock in at that at a minimum, knowing that if another bid is successful at a higher price, Rockwood shareholders will get that offer. But we felt that we would do that. We might have misstepped with that, but we felt that was okay. It's interesting that Lord Lee has said the same thing. He knows the stock extremely well. There's likely to be some more twists and turns here. There could be a completely new third party. There's still time for someone completely new to come out of the woodwork and bid. Just for those that are going, yes, but Staveley, you thought it was worth loads and loads more. Why would you agree 290? Well, because of the time period that we've got, we'd actually lock in a 200% IRR and £1 million profit in a few months, and bird in the hand and all of that. Plus, it's fair to say what happens in these processes when you start speaking to people, the board, and everyone's a huge magnifying lens is put on the businesses more than it's capable before. And Treatt does have a number of issues. There's no doubt about that. They've pitched the problems in heritage partly to do with the orange price, but partly to do with reformulation. As we all know, Paul, reformulating. Remember back in the 80s when they reformulated Coke?
Yes.
And it nearly destroyed Coke.
Yes.
You reformulate your drink at your peril. And they're saying that their clients have reformulated not using their ingredients, so at a cheaper price. Well, why would you come back again? So question mark. Secondly, they've talked a lot about premium, but the evidence is they've got bits and bobs, but they're not really on the front foot, really on the premium side of it, which would be the way to really improve the business in medium term. I understand that the tech systems are pretty are in need of investment. And equally, with the performance they've been stating, it doesn't appear that the sort of sales and marketing function is working particularly well. The current CEO is only a year in and came from a much larger business. Question mark. So people should be under no illusions. If this bid fails and it's a sort of redo, it's going to be, in my opinion, there'll be significant change to the management team, the board. That's going to take a lot of time. There'll be a new team to arrive, get their heads under changes. It's going to be a really, so people have got to be really open-minded about what that's going to feel like when it's happening.
Yeah, no, you're right. And also the trading update they gave us, which was in line for the September year endings 2025, but actually was didn't give investors huge amounts of faith in optimistic outturn for the year ending September 2026, the coming year. So yeah, I'm with you. I think the difficulties they've experienced over the last 12 months are continuing, which is what the management board said. Okay, good. Let's move on. We have to pick up the pace here, Richard, because I know we've got lots of questions to get through. Okay, we've got Emma. She's asking about Funding Circle, which I know we've talked about a few times. It's a B2B or business-to-business lending platform that did have a US operation, sold it, concentrated on the UK. It's done really well, and it had an important legal case win last week in terms of, I think, the reallocation or the reassignments of loans to a third party off its platform. Do you want to give us a quick sort of like 30 seconds, 60 seconds on Funding Circle?
Right. This is a massive potentially multi-bagger staring us straight in the face. It's a scalable tech platform that's been in operation now for many times. They did their first securitization of loans in 2016. It's a 15-year-old business now. But it's a 15-year-old business that has just literally in the last 9 to 12 months become profitable. Their target for next year is 30 million of profit and 200 million of sales. I suspect that they will beat that, and they're going to have to put out their new profit targets for this business. There is significant operational gearing. For those that don't know what that phrase means, it means that as they grow and put more volume through the platform of Funding Circle, the profits drop down, a huge proportion of those profits drop down for shareholders. And as a result, I think profits could double and triple over the next few years at Funding Circle. There's two other points that are important. Firstly, just to remind people what they do and why it's so great. It takes on average 6 minutes to complete the application. 75% of small businesses get an instant answer. The rest, they get, then people come back, yes or no. And there are a few that just need a bit more information than the basic processes to get their heads around. And they have an NPS score of 81. The business also still has significant excess capital. So it's got about 130 million of unrestricted cash. The back management team and board, since we sort of prodded them into it when we first bought the shares, which they would accept, that have been doing lots of buybacks, and there's a buyback going on now, and I think there'll be more buybacks when that buyback continues. So good growth, lots of small businesses being poorly banked by the mainstream banks in this country who need lending. They've had their main product a term loan, and now they've added a kind of card that you don't have to do one or the other, but they're finding quite a lot of people have the term loan like the card. Why that's important is because you end up touching Funding Circle as a client a lot more regularly than the 3 years you take your loan, you may not speak to them again for 3 years. So that's Funding Circle. It's on low multiples of EBITDA, even on the kind of 2026 numbers, like sort of 5 times or something like that. Yeah. But it's really about during next year they'll have to explain to everyone how much profit they're going to make in the future, and I think that's going to turn heads.
Yeah. How much of their book? I know they don't take it onto their balance sheet. They're an exchange, a platform. How much of that is?
They do a bit, Paul. This is quite an important point, and it's actually one of the reasons why it hasn't fully re-rated. Is so with the term loans, which is their most mature business, they don't take it on the book. And Citibank and various other banks sort of put the money in to say, we want exposure to small business loans. Funding Circle are great. Promise us you'll be there for putting in hundreds of millions, and they've got about 2 billion or so forward funding. And then they bring in Mrs. Miggins' pie shop and the florist, and they put it in. That just and they clip like a platform. The FlexiPay product they have on balance sheet now because they're building up to show how it works and what a great product it is. And Citibank have a kind of back-to-back fund it for them, but funding their balance sheet to do it. They at some point they're likely to say, now who wants in, we'll just clip it, or there'll be a big strategic, I would call it, argument about whether that should remain on balance sheet or not. I'd prefer them to get rid of that. It's a great product to have it off balance sheet, because I think the multiple that the stock could get on will be materially higher if they have that off balance sheet. But so far that FlexiPay is performing very, very well for them.
How much of the total lending then, either they on their book or through into third party, is subprime business loans?
So this is the thing. It's really tricky to say, because what they'll do is they'll have some that are they basically categorize it between like 5 categories. They're very good agency scores, and they'll have some that are like super prime but just can't get haven't got a relationship with Lloyds or just use Funding Circle, and they're happy to pay roughly about 5% over through to what would definitely be lower prime or less asset rich, or PG, but most people do PG. So most of it is small businesses, and this is why it's difficult to say, because they don't give data. But the reality is you'll have someone like who maybe owns a let's call it a dry cleaners, that's successful, and it's the only one in town, and has huge cash flows, has paid off his machines and needs a new machine, and he isn't going, that's his family business, and he's, he's never going to default on a loan, otherwise he loses the family business. And versus sometimes there will be, more growth style businesses that are in consumers that may have more risk. They've managed the risk very well, and I think all we know is that the forward funders continue to come back and ask for more, and indeed grow the amount they want to put through the platform, because their bad debt experience has been so good, or within the metrics expected for that level of product. It's the thing that I've sort of encouraged them to not jump on the bandwagon, but they've really hidden it under the radar. Is they've been doing machine learning and AI in their database for years. They're one of the most tech-enabled databases, because they've lent 16 billion quid to thousands and thousands of companies. So they have great data and great internal credit scoring, which they think actually, well, they've demonstrated the latest Capital Markets Day, they actually get better scores than the rating agencies themselves, which allows them to price and offer loans where other people wouldn't. So they work out it's actually not subprime, it's just subprime. Yeah, okay. So you can give them the loan and everyone else go no, and you go, well, actually you can make a return on that loan.
Yeah, well, certainly, I mean, non-traditional finance and even subprime seems to be going particularly well in the consumer sector. So let's move to that particular area. We've got Gerard Hart. He's asking about Vanquis, which was the old Provident Financial business, and amazingly, the shares have tripled over the last year. So, tell us what's driving this business.
Yes, we did talk about this on a previous Vox Markets, and we were pretty excited then. We remain excited. The management team, who are first class and were new coming into it, have done a brilliant job of beginning the turnaround, actually, at Vanquis. So we're still not really into the first proper year of significant profits, which will probably be 26, and then 27 should be the banner year, by which time everyone else will be interested in the shares with their larger funds. But basically, so they were Provident Financial. They don't do doorstep lending anymore. They just have three business lines, the third having been brought in by the new management team. The first is the credit card, which is a subprime consumer credit card called Vanquis, which they price accordingly, although actually it's nothing like Dave down the Dog and Duck, who has a slightly higher APR and a different way of collections to Vanquis. So these guys do actually have a social purpose, because often that is the only alternative for people when they need a bit of extra credit. And there are 20 million people in the country who are financially stretched. They've got about 1.7 million of customers. So that, I think the average APR is about 35%, but they do have people on lower and some on higher. They then have a motor finance business, which sort of alarm bells were ringing all over the place in the prior 2 years, but it turns out that it's not as bad for everybody in motor finance than people work. Although Lloyds aren't very happy this morning that when we were recording this, having just taken another provision. But it turns out that Vanquis, well, we knew this because we asked them the question, is that their systems were so bad under the previous management team that they couldn't actually facilitate the use of third-party brokers, which were the problems for the industry. So the third-party brokers were doing all like bad loans and all this sort of stuff. And essentially, Vanquis had no exposure because they couldn't even do it, even if they wanted to. Yeah. So they've got to clean. So they've only taken a contingent liability in their accounts, whereas everyone else, like Close and Lloyds, have had to take actual provisions. That issue, and one of the reasons they've been rallying the shares, is that's very much, I think, sort of parked now on the back foot. The second thing was that they were being targeted by spurious claims management companies who were just firing in, complaints willy-nilly. They managed to track one of them down to a kebab shop in Bradford, believe it or not. And they literally, it's literally, you couldn't make it up. They're suing the one company that's responsible for 40% of the claims. We'll see how those lads get on with that. But what they've also done is they've lobbied now successfully the financial ombudsman to change the rules of the game, which means that if the claims management company sort of sends in a complaint, if you don't come to an agreement within 30 days, it has to go to the financial ombudsman. And before then, Vanquis would have to pay, like, I think it was 650 quid for the privilege of dealing with this letter that they'd had that was spurious, whatever happened. So it was kind of like no brainer to just fire in lots of stuff. And they've changed the rules now. So now that the claims management company is going to have to pay, I think it's 250 quid, and how the spoils are changed at the end of the process. And hey presto, they've already said that the number of complaints has massively gone down. Why that's important is that they spent 46 million quid dealing with these complaints in terms of costs in the P&L last year. Coming out of that, then you've got a clean credit card business, motor finance sort of solid, and then as I mentioned, they've gone into a third area, which is second charge mortgages, which the mainstream banks don't seem to do anymore, but it's actually a really like much more lower risk kind of products. It's secured, whereas the other two aren't secured. Anyway, pulling all this together, we think that they always had a good capital stack. So they've got a tier one ratio of about 18%. They've got their deposit funded, over 2 billion of deposits, mostly FCSS people who, with their £85,000 are protected by the government. And they're targeting mid-teens return on tangible equity in 2027. We bought it on 0.2 of book.
Yeah.
It's now on 0.6 of book. We think it'll go to at least book value. Since the financial crisis, because the analysts all got book value wrong all the time, they moved to essentially valuing stocks off tangible net asset value, which is less than book. And I think we're now at about 0.7, 0.8 of tangible net asset value. I think this will definitely go to a premium, or that's our expectation. It will go to a premium to TNAV. The TNAV is going to be about 180 relatively soon in the next 12 months. And then they're going to have to work out, do they do more or do they give back divvies? When you just do a very simple model, the divvy could be well in excess of 10p a share when they rejoin the register. So and most recently they've announced that the capital stack is becoming more efficient. This would be my final for those that are financials experts. I don't know how many people are. I'm not sure if but let's just do it very quickly. Is because it's relevant. So Dave Watts, who's former HSB CFO, who's the CFO now of Vanquis, and he's a ninja as far as I'm concerned. And they are about to come into their triennial process with the regulators about what capital they need to have. And if you look at where they've got the business now to where they were 3 years ago, I bet it's odds on that the regulator says you don't need as much capital, which frees up capital, which will allow them to grow and then generate lots of profits. The final piece is that those tech systems, which basically stop them from getting into trouble if they did it by accident, they're putting in a brand new systems this year and into next. It completes next year. It's all on track. They're doing off the shelf stuff, so it's not things that should blow the bank up like they all did in the 90s and 80s when they did their own systems. So off the shelf, but that will unlock a load of extra cost savings in 2026. So we think we've got quite a lot of profit growth next 2 years.
Yeah, just in terms of the non-traditional finance and subprime, how resilient is that sector if we have a recession in the UK?
I think the key factor is unemployment. So it's unemployment is the main factor that basically causes a problem for subprime in the consumer space. But the thing to remember though is that often, particularly with the credit cards, is that they're quite you can reprice them quite quickly and you can kind of be dynamic. So although you get hit if you aren't tightening up your sort of risk parameters correctly in advance of a sort of uptick in unemployment, you can quickly sort of resolve it afterwards. They've got significant excess capital now, so it could take a lot. But just to remember, their net interest margin before they take the credit hit is 18%.
Yeah.
So they price it for credit woes, as it were.
Yeah. Okay, good. Well, let's just finish up on the financials. We've got Mercia Asset Management, which basically invests third-party funds into early-stage UK companies, largely outside of the Southeast. We've got Chris asking about what sort of investment case is for this business.
Well, Paul, being a Brummy, you'll love this business, the Kingdom of Mercia and all of that. It's a really interesting situation with a lot of frustrated shareholders who are a bit bored or teed off. Frankly, we've been building a position there. We're over 4% of the equity now. As you say, they've built probably the best regional network of early stage venture, both equity and debt. Quite a lot of it is private credit, but to small businesses often alongside some equity pieces. And they've got about 2 billion under management. They're targeting 3 billion under management. We think they've got a good chance of getting there. Some of that they might have to acquire with modest businesses that can't scale or add a particular additional specialism that's relevant that they don't do. But they're targeting 3 billion, and that should throw out a lot of profit, maybe 10 plus million of EBITDA in that year. The exciting thing here is I think the market cap, I know you've probably got it live there. Is it 120?
130, yeah.
130. So first of all, they've got 40 million of cash. Now they've said that the business, and we'll come back to that in a moment. They've got 40 million of cash now, and then they've also got in the last results they've got 125 million of investments on the balance sheet. And what they've stated,
that's their own, isn't it? That's their own investments.
That's their own investments, yeah. Often alongside something in one of the funds, I think almost always actually, but it's where they've got their own. And the top 10 of those are just over 100 million of that. So it's not like a huge, diversified portfolio. Most of those are 10 things. Just over a year ago, maybe slightly longer now, they announced that they were pivoting from being an investment company because they'd started out with investments like that and a few funds on the side. And then the funds have done really well. And they've just sort of decided, do we really want to be? It's a bit complicated for everybody. So they're pivoting from an investment company to a trading company. Now, what will be interesting to some of your listeners is that as that happens, that the stock which hasn't been IHTable will become IHTable. It's not IHTable as an investment company. Once they've sold down some of the investments and fully become a trading company in reality, then that will be an IHTable AIM stock or likely to be. And there's no IHT funds on the register at the moment. That's the point. And they're all looking for product, the IHT guys, because there's not much coming on the market. And so that's an interesting dynamic we'll see. So what they've done is they've promised to sell down the vast majority of those investments. And as far as I can tell, unless I've missed something, they've done absolutely diddly squat so far since announcing it. They literally announced it over a year ago and have sold nothing. I did mention this to management. They said, well, we never thought we'd never do it. We weren't ever going to do it in the first year. It would all be, the second and third year of exit. I said, well, I don't quite understand why you've announced it now then. Anyway, that is by the by. So they are committed to selling down those investments. Some of them are really quite interesting businesses. They've got plans for all of them. They'll have appointed advisors for a range of them now. They've said that to the market.
I think it's about 80 million, isn't it? They're thinking of the 120. I think they're selling down about 80 mil, something of that.
Yeah. And they've had quite a good history actually of being conservative about their valuations of those businesses. The market's obviously implying it's the same as some of the other kind of books of investment, that they're all worth half of what Mercia say they are. And we're only going to find out. We'll find out in the next 18 months. They've also said that they'll need to put in about 17 million of cash. I think it's slightly less now. They've done some of it already into some of those holdings just to take them through to exit. But I think again for medium-term investors, what you get by the end of 27, you should have a £3 billion AUM business making lots of profits. By the way, that kind of because it's specialist AUM, high margin, decent fees, sticky money. That would be a kind of 10, 12, 13 times EBITDA multiple. You should then have all the cash come in, which is either returned to shareholders, will probably be some of it will be returned to shareholders, or may be partly used in some M&A to accelerate those targets.
We're going
to hold them to account for their promises they made to all shareholders in 2025 for 2027.
No, you're exactly right. If they've got 40 million of cash, plus they're going to sell 80 million, that's 120. You've got a market cap 130. So you get the AUM business for free. Sounds like a Christmas bargain to me. Okay, right.
More succinctly than I did, Paul. Sorry.
No problem. We got Ben Sharman. He's asking about Trifast, which is an industrial fasteners group that has been trying to turn around for quite some time. I think it's now recently been hit a bit by the tariffs. Auto sector's looking a bit poor, particularly with JLR and with the tariffs as well. Industrial sector in GDP is not great around the world. How do you see this one going forward? I know they're trying to increase margins, aren't they?
Yeah. So I think there's two things here. I think you're absolutely right. They've got a really tricky end markets, which isn't their fault. It is what it is. They're global. They've got operations in Asia, Europe, UK, US. And, it is fasteners, it's nuts and bolts. So it's pretty GDP. And you're right, autos are a market. And I'm pretty sure I think if you ask them, they'll tell anyone. I think JLR are a client. Although I would suggest that they don't have any really massively dominant clients. So it's not a sort of Filtronic type issue where if there's a problem with Starlink, it's really big news. Now the key thing is they have actually been doing what they've been delivering in terms of what the plan was. So the business used to make 10% margins every year. We were involved with refreshing the whole lot. So we've changed the chair, the CEO, the CFO, the heads of the divisions, and and there's a really, really high quality team in place now under Ian Percival. The margins have got as low as 3.3% as he sort of took over the business, and he's got them now up to 6.7% despite quite difficult markets. So he's on track. I think the target's 10. I think the competitors do a bit more than 10. I think he'd be disappointed if he didn't get to that target and improve it over time. But I think we all know when end markets are where they are, sometimes you just that progress might pause as they did. And that hasn't been the case so far. Because it's so self-help driven, that sort of offsets. And that's the same with a range of Rockwood stocks where end markets don't make it easier for them. But if it was a brilliantly run business, there's nowhere to hide. But the business they took on was not being run very well. And they've restructured the UK. There's other operations which they've been looking at more recently. And the point being is, if they get back to 10% margins, we would expect them to be on a one-time sales. EV sales of 1. The sales are about 220 million, and market cap's probably 110.
Yeah, they're at about 0.6 sales I've got at the moment.
Yeah. So that's why we think the shares should double from now. Balance sheet's in good shape. They've got the stock down. They've got decent facilities anyway. And I would say one piece that people probably haven't heard them or haven't really latched onto yet, which we think is really interesting, is that they are in smart infrastructure. What does that mean? Data centers. So these boom racks and the HVAC stuff and everything has a lot of fasteners in, and they are definitely got a decent client suite in there, and that's growing really strongly for them. It's still quite a small, it's like single-digit percentage of sales today, but with what everyone's seemingly predicting over the next few years, that could become quite an interesting end industry segment for them, and maybe offset some of the more mature industries which they're exposed to.
Good. Okay, well, let's move on to EdTech. We've got Sarah. She's asking about RM, that I think basically have got a number of divisions. In fact, it's got all the hallmarks of Rockwood all over it, because it's a sort of unbundling. And they did a placing. Was it Friday? I think it was Friday. I think it was 13.5 million at 98p. Anyway, what's the sort of the investment case here?
Well, this is alongside Capita. I don't want to put down any of my other holdings, but the biggest upsides, I think, are probably Capita and RM. And as a result, on Friday, we added to our holding materially and increased our investment again in RM. Why? Because two things. So the market cap after the raise probably about 85. Is that what it's saying this morning? Just you'll have to check.
99. It is.
99 now. Sorry, 85 plus the 30. Yeah. 99 million.
Oh, sorry. No, the market cap. Sorry, you asked me about the price. Yeah. The market cap is is 83 million.
Yeah, that's more like it. Yeah, and then plus so a bit more. So our sum of the parts is 170 million pounds. And we have been consistently saying publicly and also discussing with the management for years that the way to unlock value for this business is to pay down their significant debt load, which the banks have been very supportive for, which is now nearly £60 million prior to Friday, where the 13 comes in, and but sell off each of the divisions, 2 of the divisions, and then decide whether the stock market can value the remaining division appropriately or not. The reason being is one of the divisions is an absolute hidden gem. I mean, it's just it's fantastic business. So what's really important is on Friday, for the first time explicitly, they said that they were going to refocus the group, and that those disposals are going to be front of mind for them going into 2026. So those 2 divisions, one of them is a technology business, that 50-60 million of sales, that does outsource tech provision for schools, runs the broadband, makes sure Johnny's not on the wrong websites, that sort of stuff, and manages all the school intranet and that sort of thing. And they're public sector clients. They make sort of low single-digit type margins. It's fine, but that business we think is worth about 35 million quid, and they should be able to sell it. There's a range of people in the industry. The second one, which is a bigger business, is their resources business, which is now called TTS, and it is a very, very good management team that's in RM. Again, full change. Got new CEOs, CFO, head of transformation, new heads of all 3 divisions, new head of HR, new head of tech. I mean, it really is a complete clean sweep under Mark Cook. And that division had a problematic other business within it that they've got rid of or closed down. And TTS, what's remaining, is a well-known and very well-respected market leader in the provision of kind of teaching aids and curriculum aids for schools. Touches a lot of schools in the country. I think it's 90% of UK primary schools, one way or another. That's a distribution business, big warehouse, lots of stuff. They create some of the stuff there themselves, which has higher margin. A really attractive business. They've stabilized that now. That should be able to make like 10% margins, and that's got so we think that's worth about 70 million quid. I mean, it might be worth more or maybe slightly less, but that's our view. Is worth, they could get 70 million quid for that. So the combination of those 2 gets you in 105 million quid if we're right, paying off the debt now of about maybe 55, because they're going to spend some of that cash, the reason for the stuff. So leaving you with this final division. Now the final division, we think, is worth at least 150 million quid today, and could be worth 200 million quid in short order as they finish the investment phase for what's driving that division. It does assessment. It does mark schools exams. It actually marked 14 million exams, I think, this summer in the UK. Well respected, top class clients. The ICAEW accountancy exam, the Chartered Institute of Tax, Cambridge Assessment, and their biggest client is International Baccalaureate. And International Baccalaureate is obviously global, and they've given them this whopper contract to basically digitalize IB over the next 2 to 3 years. And as a result of that, RM, the new management team, are basically creating a platform they call Ava. And Ava is going to be this amazing platform that all the clients can use, and new clients, and all new types of exams and otherwise, and essentially will be very, very profitable, and with growth become increasingly profitable. So growth and high margins, we're talking 30% plus margins.
What's the turnover on the assessment business?
Right now it's about 45 million.
Okay. So three times sales, you're saying, isn't it then, essentially, at the moment?
Yes, but what will happen, 2 things will happen is that they will bring more product into that as they grow. Like IB itself is growing. And secondly, what's interesting is at the moment within that assessment division of 45, they make profit on the IB non-digital, partial digital processes now. But as they go fully onto the Ava platform, the profitability of each script goes up materially. Now, IB don't mind, because by doing that, IB will actually save lots of money themselves with their own cost base and how they manage the exams. So it's a kind of win-win for both examples. So we see profitability going up and very sticky once they're on the platform. And ed tech, which is the sort of groovy word people use, is in private markets, is very, very hot and has been for many years. And this will be a world-class ed tech business coming out of that. So yeah.
So just for Sarah's understanding, in terms of that digital assessment business, if I'm a pupil, Johnny, and I'm doing my exam, does it require me to be on a PC in the exam halls putting stuff in, like as the IWC, the accountancy champs would do? Or is it basically somebody still can write on it in a piece of paper, and then it ingests that paper script, understands it, and then marks it digitally by using sort of like language identification? Is it automated, or is it still using
at
paper?
The moment it's the second, and with scanning and it's moving, it will move to the first. It will move to the first. Yeah, eventually.
I can see why you're excited about it. Yeah, no,
Yeah.
that digital assessment business, that's going to have huge operating gearing, isn't it? Operating leverage.
There's another piece in it as well. Is obviously, which is more controversial, which they're not pushing because it's a bit of a journey. But at the moment, physical people obviously do get involved quite a lot with the marking of certain types of exams and exams like that. And obviously, AI could have a role longer term, but the clients have got to want that. But once you've got the platform, it is capable of doing that. So I think the key thing is that there's going to be serious. We're coming up to Guy Fawkes night. If by next Guy Fawkes, we haven't sold some of these divisions, right?
Yeah.
Right. There's going to be serious fireworks, and probably earlier than that.
Yeah. Okay. You'll be on the board, I can tell.
Well, okay. No comment.
Okay. Right. Let's move. I got Tina. She's asking about the one you mentioned, Capita. So let's focus on this one, because it's really been a disappointing share for 20 years. It's one of the UK's big outsourcers for public and private sectors. It does things for the government. I think it does the congestion charge, but it also does contact centers for telcos, etc., which is pretty soft market at the moment. Why is this one of the sort of like the jewels, the potential jewels in the Rockwood crown?
Okay, so market cap 330 now.
What have I got? Yeah, 400 actually. I've got this morning.
Oh no, sorry, that's because on Friday they won the contract to, I believe,
yes,
run the civil service pension scheme, and it went up 11% last Friday. Apologies to everyone, we couldn't get this in beforehand, but I didn't know that was going to happen. But so yes, probably up to 400 now. We think it's worth 900 to $1 billion. Wow. So loads to play for from here. Why do we think that? So first of all, again, it's just a bit like a broken record, Paul. Sorry, but new chair, new CEO, new finance director, new head of transformation, new heads of all three divisions, new people officer, massive change, and led by Adolfo Hernandez, who had come from head of Amazon Web Services Europe, who was weaponizing AI tools into Capita, which frankly was broadly, to a greater or lesser extent, asleep at the wheel with regards to the use of those. So he signed mega kind of contracts with Microsoft, with Salesforce, with Amazon to inject AI both into what they deliver for clients and also what they're doing with the business themselves. That's allowing him to be nearly there within the next 6 to 9 months. He's nearly finished a £250 million cost-cutting program. To put it in context, he announced that when the market cap was 250 million, which is just fantastic stuff. Anyway, so he's taking out loads and loads of costs. The business itself, he'd inherited most of the hard work on the balance sheet and the pension fund were done by the previous team, who'd actually sold off a lot of businesses, and so the debt's now down to about 150 million, EBITDA about 250 or something like 225, 250, something like that. And also money went into the pension fund to get rid of the pension fund issue. So what does that leave you with? As you mentioned, the public sector division is the really interesting piece. That business is actually it's sort of stable. Would be nice if it was growing a bit better, and I think they'll be working on that. But beautifully formed with nearly 1.4 billion of sales, making nearly 8% profit margins, converting 75% of that into cash. And we think that business, if it came to market as an IPO. Have you heard of that? It's when a company lists on the London Stock Exchange. But if it, for the first time, if it came to the London Stock Exchange for the first time, we think it would get, even in this horrible UK stock market, probably a £900 million valuation. That's it. And you mentioned the congestion charge. They do everything that we hate. So they do the TV license. They do the what do they do? You mentioned the congestion charge. I think they do the student loan company. They do primary care, back office for GP surgeries. Really good business. Then you've got the problems. Well, you got two problems and one other little hidden gem in there. Let's do the problems first. They inherited this absolute mess. The previous guys have been signing evergreen contracts to run sort of pension fund contracts, and they've had to. They're all loss making. One of them's still losing like 20 million quid a year in cash out of Capita. And Adolfo's got it down to the final contract to get rid of, and he still needs to get out of that. But because it's evergreen, that's going to be expensive. So, newsflash, I think that'll cost 100 million maybe to get to. They'll have to give to get out of not spending 20 million a year for the rest of their lives. I mean, that's just a guess, but you've got to put something in, and that's a kind of unknown. But we'll put that in. So they'll have to do that, which will jack the debt up when that's done. But then we'll cauterize that problem and also help with overall free cash flow conversion for the business. The second problem is the contact center business to the private sector that you mentioned, and that is loss making this year. It's been bouncing around, loss making, break even, doesn't really make a profit, although all the competitors do. So this isn't like a bad business, bad industry, which might be what people think it is, but actually most of quite a lot of listed competitors around the globe make double-digit margins in contact centers. But it does appear the game in this is scale. And although they're big, they've got, I think, nearly $1 billion of sales in contact center. Maybe it's slightly less. They're probably not big enough. So we'd like them to get rid of that division, offer out the scale to someone else who can sort of immediately get lots of synergies, take on all the clients and the contracts, and also there's got quite a lot of leases in that business. It was first round BPO, so it was sort of large call centers in large offices in Sunderland, and now that whole industry is not really based in Sunderland, and they need to kind of AI it, and which is what they're doing. Take out costs, take out property costs, make it more efficient. And then the final piece they've got is so we have a very modest amount in for contact centers, but very low amount, not a negative, mild positive. And then the pensions business they've got is the one where I think that's the division that will have won the civil service one, where they administer pension funds. It's a bit like there's another listed stock called XPS, which everyone loves, on a high multiple. I think it's on like 11 or 12 times EBITDA, and because they're good businesses, and Capita's got one of these, like hiding in there. And I think it's got about 200 million of sales and is making about 30 million quid. Right, 15% profit margins, and it's absolutely gem. I mean, you could probably sell that for. Well, when we were buying it, you could sell it for more than the market cap. It's probably not worth 400 million, but it's worth easily 250, maybe 300 million. That business. So that's interesting. They've still got that. So we expect that to all clear up. They're targeting 6 to 8% margins. They're targeting to start generating cash. They've said they're on track to start generating cash in this quarter for the very first time for years. So next year, they should be into generating cash all year. Next year, they should be into improving the margins. As I said, public sector's already there. They need to we'll have catalysts, hopefully, from the final contract, from hopefully something to do with contact centers. And then that should unlock all the value. Whilst for those that don't really like some of the parts, that's also too complicated, Richard. I mean, the PE is sort of 6 or 7, and the EV is about 3.5, and it's not overly levered. Even if they do, I think they've been waiting to do the dairy. I call it to get rid of. I think they've been waiting till they actually go. Yeah, we're cash generative now.
Yes.
And we're cash generative now, and we can see that that's going to be the case. Okay, we can take on the extra debt to sort of solve that problem.
Yeah, they haven't got any other dead bodies in that group at all. I mean, that you said there was that's the last piece, because they keep shrinking, and then because of the working capital, the cash keeps going down, which is optically looks a bit weird.
Yeah, I think that has been the working cap has been, and partly that's to do with they're actually forced to do the accounting policy, and they had an accounting scandal a number of years ago. That's all behind it. So now it's clean accounted how they should account. But because some of these contracts are multi-year, there is contract accounting in there, which isn't helpful.
Yeah, okay.
I think from a kind of to being frank, I don't think there are bodies buried, but I do at this point. But I do think that any business like this retains specific contract risk. You sort of muck up the civil service pension scheme, or you muck up the congestion charge. That's going to be an expensive day in the office. So there's no doubt that probably means that's why it probably won't all end up on 14 times, but it might end up on 10 times.
Brilliant. Okay, well, we've been going now for 65 minutes, Richard. Now I ask everybody what your favourite stock is. Now you've already said that you ones with the biggest upside. You've got this Capita, and then these RM and another one. Is there anything else in there you'd like to highlight at all? You've got this float.
I think there is. Yeah, no, I'll give you one that I thought we might discuss, but we haven't. But only because it's reasonably high risk, but not as much risk as everyone thinks. So the stock's called Kooth.
Yes,
Kooth. It's the leader in digital mental health provision in the UK. Market cap is about, right now it's probably about 35 million or something ridiculous. 40 million.
Yeah, I've got 52 actually.
52. Okay. Yeah, 52. Oh, and that's because I'm thinking about the cash. So they've got just under 15 million of cash. So the EV is probably 35 million or something like that.
Yeah.
The Kooth, as I said, market leader, been around for many years. Lots of NHS trusts, I think over 100. High retention rates. Quite a difficult end market, the NHS at the moment. But so they're they're making ends meet. It's quite difficult, but they're sort of trying their best. It's solid. The reason I mention that is because it proves that they know what they're doing. You don't get to be in 100 NHS trusts if it's just sort of some sort of whiff-waff type of service. It's obviously beneficial. And in fact, I think over 2/3 of teachers in the country have brand recognition of Kooth if prompted. That business, I understand, the UK business does about 17-18 million of sales. I think might make a contribution to central costs of about 4, meaning that business itself is probably worth reasonable amount of money, highly profitable, mid-teens margins, 17 million of sales, which is quite helpful when the EV is only 35. Yeah. So my view would be that the cash and the UK business sort of protect your downside in a worst case scenario. Now, the worst case scenario is why the shares are kind of where they are, in that it's sort of it's the problems of victory. They won this massive $200 million contract with the state of California as part of their mental health $4 billion mental health act, and that's 2/3 of the rest of the sales per year. And they've spent a couple of years basically putting that, launching the system mainly bespoke for America. It's called Soluna in America. And they're kind of being almost sort of paid to upgrade it. It's now translatable into over 30 languages. It's got extra sort of aspects to it. But doing the same thing, which is providing mental health provision to young people who wouldn't normally get it. And obviously there are quite a lot of sort of rather wealthy people sitting in the west coast of America who probably get counseled every day by their parents, shrinks, they're obsessed with it out there. But there are lots of communities that don't get that. They sort of, Johnny who's feeling upset about things gets a whack round the head and told to, bug his ideas up. And that's not very fair on Johnny. And California, really, really believe quite rightly in in the mental health challenges that lots of young people have. So it's free at the point of service, and you get to speak to, if you want to speak, you can, but a lot of them chat to a real person and then get to video if they need more and more help. So it's very user friendly to young people. There was a load of noise over a year ago, which is when we started buying, that they were going to lose, that they were sort of mucking up on the US contract, wasn't going to be a success, no one was using it. And as a result, the shares now reflect a worry that they won't renew the contract when it comes up for renewal in 2027.
Yeah.
Our view is it will be renewed. Our view is it could be renewed and possibly even expanded in 2027. Since then, they've won New Jersey, a pilot, which they've then renewed in the last couple of weeks. And the company have been very clear that their main objective is to renew, and that they've actually started very preliminary discussions already with California about what the future looks like. I would point out at this point is that California's been Democrat since 1992, and Katie Porter is currently the front runner for the new governor. So currently it's Governor Newsom who sponsored this bill, but Katie Porter was the co-sponsor of the Mental Health Act, Justice Act. So she takes it very seriously, and doesn't feel to be the type of individual that would then sort of get rid of a service like this. It's important to understand it's got high drop-through profitability. So, because it's a platform. So if they do start announcing contract wins in the next few months, and indeed this is the period where they're likely to start announcing wins, because the states have their kind of budget periods through to June, and then they get agreed at the end of June, July, and then they start to actually do the contracts, and some of them are backdated. It's like, classic public sector, sort of ridiculous. But they'll, if they win them, if they announce them shortly, they'll be sort of backdated back to June.
Yes.
And I think the key thing here is that their drop through profits, we believe, are about 45% for the value of any contracts that they sign, which will continue to build. Now, they are profitable already. So we've got a profitable business. The US contract's profitable. And just to complete this off is that they've shown very clearly that they're up to 130,000 users in California, that they're meeting the criteria of hitting particular precincts, probably not the wrong word, but boroughs, where there's they're worried about certain types of communities that don't get access to mental health, and they can, with this system, they can go, they're using that, so that they're meeting the sort of objectives of the overall contract. So we think they're in solid shape. I would say this, just one final point is, so as a result, it's on like 3.5 times EV/EBITDA. It's basically the ARR is like 60 million plus, and its market cap is 50. And if they renew, people are just going. You can't just go. If they renew, then they're in California. But long term, it's going to be part of the fabric. And what we do know is that, I think, because it's public information, when the process to win California, I think 400 people applied for that contract, including some serious dudes like Google and United Health and people like that. And maybe at this point, they're sort of sitting there going, let's see if California do renew. Difficult to take to the board, isn't it? If you take it to the board and then you lose the main contract, you probably get fired, don't you? But I think if they do renew that, and then the stock market still doesn't care about Kooth, someone will come in.
Yeah. Is there any risk at all with the government shutdown in the States at the moment? Because winning new contracts must be tough when they're all furloughed.
This is state. It's all state.
Oh, okay. And the states are okay, are they?
Yeah, they are. Yeah.
Oh, okay. I thought it was the whole of them. There's a national park.
No, I don't think so. I think my understanding is it's fine. Yeah.
Okay, cool. All right. Oh, brilliant.
We're 2 weeks in. Yeah, we're 2 weeks into this. Those shutdowns typically do get resolved, don't they? It's just
they do. Brilliant. Okay, fantastic, Richard. Thanks for all the comments. Any sort of closing remarks for investment? Obviously, you've done brilliantly, or the fund has done fabulously over the last 3, 5, even 10 years. Any sort of final comments in terms of what investors and shareholders should expect?
Look, I think we're in good shape. We have very high confidence currently with the top 10 positions. They're all in quite they're not particularly new. Some of them have sort of got to where they are, so we're and delivering the goods. So we're kind of confident with the portfolio right now. I think one of the things I would say, I know your audience probably like stock picking as well as buying trusts. The types of investments we invest, aren't for widows and orphans, and that's why. But Rockwood does have, because of its concentrated approach, you get a good exposure to each of the things we've discussed today. So I would just remember Rockwood rather than necessarily go for it on some of our holdings. It just depends on your personal risk appetite. But I'm not trying to make a recommendation or anything. I just remember that funds do manage risk quite well, and if you want to proper no sleepless nights and all that sort of thing. I think finally, the only final thing I would make is that we've got the budget coming up. Sadly, I believe we're afraid not much is going to go on until we've got clarity about what she does with that budget, what taxes she changes. But I suspect that clarity will be reasonably helpful once it's done, even if it's not what people want to hear or they do. But her almost more important thing, other than closing the gap, is to just make sure it's a point where they can have we can have sort of tax clarity for the rest of the parliament, rather than what we've had, which is she didn't do enough last time and now everyone's worried. The thing was, although the Tories did, and this isn't partly political, but I think it's factual, whilst the Tories did on a number of occasions actually increase taxes quite carefully, they won over basically everyone's view that the Tories essentially, if they can, they'll cut, and they're basically trying to cut. So corporates and consumers, sort of when they're in power, sort of knew taxes broadly weren't going to go up. So you could kind of plan on that basis. She sort of flipped it round, that everyone's wondering what's next, what's going to hit me next. And that's just stopping decisions by both companies and a thing. And I think if she can get ahead over that, it'll help her with her growth agenda in the final, because however painful what she announces is in November.
Yeah, I think the bond market want that as well. So cut your cloth there, Rachel, and we might take as well. If you do that, then the bond market will love you, and you'll have to pay less interest. So
I think that's true. The problem is her very large number of MPs who didn't think who actually didn't think they were going to be an MP. Let's face it, about 100 of them. They were quite surprised to be an MP, who are now looking at Nigel and sort of wondering if they're not going to be an MP again. So she's got a difficult party to manage. That's the problem.
Yeah. Brilliant. Okay, well, thanks again, Richard, and very much looking forward in touching base again in about 6 months' time. So thanks again.
Thanks very much, Paul. Cheers, and thanks for everyone for listening in.